Okay, this we are going to unpack, keeping in mind your invoice that you did for Kitchen Candy. Okay, so remember previous slide, I spoke about the Kitchen Candy business on VC Learn. Firstly, you were asked to advise them about the different methods in which they can account for their VAT, so the payment and the invoice basis. And then I said to you that for some practical exposure, you are asked to complete an invoice for them. Okay, so I'm hoping that you would have that in hand when I am speaking you through the section on the slide. I think it gets a bit much if you don't have something to refer to. Okay, so I'm trusting that you've done this invoice. Your lecturer can give you a solution as well to make sure that the template that you are working from is correct. Okay, and what I'm trying to do with this slide is just to bring everything together, because now you've done your own invoice. You've written out company name, address, the things that someone sold, bought, and the total rand amount. So what I'm trying to do is, if you look at that source document next to you, the Kitchen Candy invoice, that tells a bit of a story. Okay, so every source document really tells a story. I always say if you understand accounting, we're obviously aiming that you would eventually move towards, you'd be able to look at a piece of paper, an invoice or a toll slip, and almost be able to write like a word summary of what happened. Not because anyone explained anything to you, but because you are now, starting to speak the language of finance or the language of business, in terms of accounting and financial information and source documents and VAT and classifications of transactions, etc., etc. You should be able to take something like that Kitchen Candy invoice and almost tell me a story and tell me, okay, this is what happened. And that's how I'm going to classify it. You don't need anything else. Okay, and that's what we're aiming towards. So I'm hoping that you follow with me with your Kitchen Candy invoice. I think it's a very good test at this point in time before you move over to Learning Unit 4, which obviously takes it up another notch. Are you on the same page? Are we all on the same page? Do you see what I see when I look at that invoice? Okay, so that's what I'm saying. It's very important that you have the correct one in front of you. Please make sure that your lecturer gives you a solution or that yours is 100% accurate. Okay, so firstly, I'm going to start on the left of the slide. So the items in the invoice, bought or sold, was VAT exclusive. Okay, they were quoted to you without VAT. Without VAT means VAT exclusive, and that means 100%. Okay, and that means VAT needs to be added on to the 100%. Total invoice, 17,100. How do I add VAT? Times 15 over 100. Okay, equals 2565. So that's how I put VAT on to an item without VAT, by adding 15%. If I've added the 15%, the 2565, the total invoice price would be the invoice 17,100 plus the VAT that you've just worked out. Okay, so final invoice price 19,665. Okay, we spoke earlier about the breakdown when I mentioned the Walton Stationery example. So this 19,665 is not what the business is going to keep, remember. It is what they'll book in terms of money owed or money paid. But we now know that the 17,100 in reality belongs to them, if you want to say belongs to them. And the 2565 is actually SARS's. Okay, that's the VAT that's going to go to the South African Revenue Service. So the green section, I just want to illustrate how you can work with this invoice price in a different way and play around with the same numbers. So you have the total invoice price. Okay, for you to work out what is the VAT based off of that, multiply with 15 over 115. Okay, why 115? Because 115 is 19,665. Remember I said to you we work with 115, 115, and you need to know inclusive is 115, exclusive is 100. So play around with the relationship between the number 1, 2, and 3, VAT inclusive, VAT, and VAT exclusive. And that's what this allows me to do. I can take the final price, which is 115%, okay, 115%, multiplied with 15 over 115, and I get the VAT. I can multiply it with 100 over 115, and I get the exclusive price. Okay, and again, together, those two give me the full invoice price. Okay, I reminded you about my method below at the bottom where I say, remember, you multiply with what you want, you divide by what you have, the percentage now. So if you want 15%, multiply with 15%, divided by the percentage that you have. And if you have 19,665, you've got 115%. Whereas if you take 19,665, you want 100, you want the exclusive price, you want 100. So multiply it by 100, divide it by 115 because that is what you have. Not to confuse you, but you need to know very clearly, and that's why I said the relationship between 115 and 115 is extremely important. You need to know clearly what it is that you want. So do I want 100? Do I want 115? Do I want 15? And also know clearly what you have. Do I have 115? Do I have 100? Do I have 15? Okay. Because this multiply with what you want, divide by what you have only works if you know very clearly what you want and what you have. Okay. So just to look at this Kitchen Candy invoice in terms of, I want to say almost journal entry breakdowns, taking you back to Learning Unit 2 a bit with debits and credits. So what Kitchen Candy will book in as money received. Okay, they made a sale, is 19,665. So bank goes up, happy, you debit bank. You can see it at the bottom over here. Remember, we said every sale that we make, every piece of money that we earn, Kitchen Candy has to give 15% to SARS. But remember, the money that they receive is 115%. So 15 of 115, which is 2565, they will end up giving to SARS. Okay, so we credit that output. We know it's that output because of the fact that we have to give it to SARS. We owe it to them on our output, which is the sales of our products. Okay, and then the rest, the balancing figure, we credit sales. Okay, take note, I don't want to spend too much time on the balancing of this, but you can see there are two credits, one debit. You can't do it like that. We just kind of merge the one bank. The debit matches the credit, which is a very important check. You can ask yourself, based on Learning Unit 2, does this make sense that I credit that output? Yes, it does. It does go up. The liability increases. Credit sales. Yes, it does make sense. I have just sold more. Debit bank, does that make sense? Yes, I have received money. Okay, so again, just breaking this down one last time. I've received 19,665. 2565 of that's going to go to SARS. The rest is actually my sales. Okay. On the same invoice, Kitchen Candy sold to Smith Traders. They, on the other side of the spectrum, they have just purchased something, okay, for 19,665. So they bought something, money paid, 19,665. So their bank is going down with 19,665. They just spent money. It makes sense. They've paid everything to Kitchen Candy. They credited their bank. But remember, for them, for Smith Traders, this has been a purchase. So if the purchase of standard rated items, they can claim 15% back. Okay, you can ask yourself again, based on the VAT categories, is this a 15% standard rate item? In our indication in this example, yes, it is. So 15% of the 115 percentage, that is 19,665, which is 2565, they can get back. Okay, so 15 of 115 of 19,665, they can get back. It's that input. They can claim it back. It is an asset. It does make sense that we debit it. And the rest, the value of our inventory is actually 17,100. Okay, we debit the asset that we just bought. Okay, so again, summarizing Smith Traders' purchase transaction one last time. We are spending money. We just spent 19,665, But luckily, of this 19,665, we are able to get 2,565 back by putting it in the VAT column, classifying it as VAT input. We are allowed to get it back. So the actual amount that we spent on inventory is only 17,100.